Welcome back to Indianomics. We have been speaking with the creme de la creme of the Nomura economy team about how the world economy, the Asian economy and the Indian economy will shape up in 2018. Well, let me come to you, Yang, now. On China, your report says that there will be a slow deleveraging in China. The world is quite scared about the shadow economy in China, the shadow NBFCs, lending companies. Will we see anything destabilizing in terms of the way in which the shadow economy is brought under control?
Well, we already see a pretty significant deleveraging this year. I would say it achieved some, to some extent, it made some achievements. We see that debt to GDP ratio overall for the economy has been slowed down a little bit, and particularly for the corporate sector. With the rebound of the PPI and the rebound of the property sector, profitability of corporate sector has improved quite significantly. So the leverage for corporate and has been deleveraged quite significantly. But I wouldn't say it's a destabilizing. I would say these deleveraging will continue, but as a kind of turbulence factor, it more stabilized than what we have seen last year, and as you mentioned, like 18 months before.
Yes, so that really is the fear. You know, your report says that China will be one of the slower economies in Asia, slower than in 2017. That could mean more dollars fleeing China and moving to other economies, probably India, but probably back to the developed economies. Is that a destabilizing factor, a yuan depreciation, more than what Asia is prepared for?
Still, I would hesitate to say so. China is slowing, but it's compared with previous quite strong growth level. I mean, China, our forecast for next year is 6.4%, same as India. Compared to this year, possibly we're going to end up with 6.8%. So it's slowed down a little bit. But I wouldn't expect dollar flee China very much. Several issues. One, China still have pretty strong trade surplus. And second issue is that the PBOC, the Central Bank of China, has imposed increasingly restrictive capital control over outflow. And meanwhile, China is open up further to welcome capital inflow. So they might offset the outflow what we have seen like 18 months ago a little bit. I mean, overall, we would still see capital outflow, net capital outflow from China. But I would see it's moderating compared to a year ago.
Well, let me come to the rupee itself. One of the problems have been the rupee appreciation. For Indian manufacturers, there is an import threat as well as exports not at all doing as well as the world trade would have us do. How will that shape up in 2018?
Well, I think, first of all, on this, exports not shaping up well, this is very surprising, given that it's coming in the backdrop of, the synchronized recovery. Part of this could be because the recovery we've seen on exports is more tech-oriented and India is not there in that particular basket. But it seems like the reason is more to do with, refunds not coming back, the supply disruptions that have happened. So it isn't really because of rupee, whether, the export decline or the import increase. So it's more important to resolve these issues. But I think, at rupee, the current account deficit, in our view, is going to widen. We are predicting a recovery in growth. We are predicting higher oil prices. And so we do think that the current account deficit is going to widen. Our forecast is about 2% of GDP. But we are also positive on FDI inflows. I think, all these reforms, the ease of doing business, the sovereign rating upgrade, all of this ultimately, GST means more long-term capital coming in. So a significant portion of the current account deficit is funded through the FDI flows. and in the near term we do think the Goldilocks environment continues, so India will attract flow. So balance of payment is not an issue, and therefore we do think that the pressure will still be on the side of appreciation.
So what is the rupee average or range or end 2018 rupee dollar rupee exchange?
So by the end of the 2018 we're looking at around 63.5 against the US dollar.
And on an average it would be 63 rather than 64?
Well, on an average it will be probably closer to 64.
Okay.
So
now then, Sonal, what is your optimism for so much growth? I mean, at the moment CapEx is not fired, public investment is not, I mean government investment is not by any means gone through the roof. So it's only the Indian consumer. If the rupee is going south of 64 in exchange rate terms, 63.5, then what will bring the 7.5 growth?
So I think, if you look back at the last 2 quarters, actually one of the biggest drags on growth has been net exports. And again,
absolutely.
No, but that has been not because of rupee, that has been because of the supply disruptions. We are seeing exports go down and imports go up. So one is actually the contribution of net exports should be, less of a drag.
Okay.
But I think, in general, on your question in terms of the triggers, we do think that the remonetization process, and I think we have underestimated in 2017 the negative effects of demonetization, and similarly we could be underestimating the reflationary effects of remonetization, especially on the cash-intensive sectors. We think that's going to be very positive.
So consumption will fire.
Consumption, a lot of cash-oriented sectors. This bank recapitalization also is going to be positive. If it does lead to growth capital, potentially it can lead to 8% increase in credit growth, and we are seeing initial signs of credit growth picking up already. The GST Council has reduced tax rates.
Yes.
They are trying to ease compliance, so we should not assume.
So the consumer fires. Who else fires?
Well, the consumer fires, the private investment side, the true pickup in capex cycle is still some time away because the balance sheet adjustment is going on. But we've seen almost, close to zero growth in fixed investment. We do think that's going to be a bit better going forward. From the government side, not so much consumption, but some of these, Bharatmala projects, etc. The government component of public capex, we think is also going to contribute to growth going forward.
Well, my final question to all of you actually is on the froth in markets. I mean, what would 2018 be the year when the ghost of 2008 revisits us, probably in the form of Bitcoin? What's your view?
I don't think there's much in terms of, I think for those individuals that are in Bitcoin, but in terms of the systemic effects on economies from, say, some of these cryptocurrencies, say, coming off a lot, I don't think it will have big
funds
effects.
and banks are exposed.
I don't think much at all.
What about in China, Yang? There is a shadow NBFC. Are the Chinese, the PBOC and the authorities pretty sure that there will be no domino risk from the cryptocurrencies?
Actually, China has cancelled all those cryptocurrencies, particularly Bitcoin.
Yes. But you can be pretty sure that the shadow economy is still not trading in them?
Not in China. Probably, if it's online trading outside China, might still some China-related trading there. I heard that, like Bitcoin, a lot of trading actually was implemented by Chinese people. But within China, financial system is not a big deal right now. Yeah.
Well, I would assume in the Indian financial system as well, Bitcoin would not be a risk. But final question to you, Sonal, what's your sense of the risk in India? We are still awaiting the Gujarat, Haryana elections. Would the turning in the fortunes of the ruling party be a very big risk?
And there are so many such events through 2018, so it's honestly not going to stop at Gujarat and then Karnataka and then, Chhattisgarh, Rajasthan. So every election will be seen as a referendum. So these will be event risks we need to navigate through. Ultimately, it's 2019 when we'll really get to know. But I think in the, it appears that at this stage the risks to India are from a growth perspective, more external, whether it comes through, financial market turbulence or China-related risks, or, how oil goes, so the risks appear to be more global than domestic at this stage.
Okay. Well, thank you very much, Rob, Sonal and Yang, for joining us. I think this is about the most positive reports or positive forecasts of 2018 for India. 7.5% growth, 4.6% inflation, a currency that will be perhaps largely stable, in fact appreciating, and most important, India likely to be a tiger economy, even if it's a tiger cub economy in 2018. Thanks to Nomura, we await 2018 with very eager optimism. Thank you very much.
Thank you.